afternoon, good morning, everybody, or good evening, wherever you may be. It's Thursday, or the end of the month, December 4th, and a suggestion came up that we talk about where the CM is and where the CM is present, and it's a very good topic. I try to bring that up all the time to people, but let's do a little more specifically on that particular aspect of it. And I try to explain that all the time in videos and all the time in my newsletter, but let's talk about that specifically. So the role of the composite operator, and Wyckoff called the composite operator, and we call it the composite man, is simply a term that is something that is the market thinking itself. Okay, mark is thinking of itself. In other words, what are all the great minds in the market talking about, or what are they trading? Well, if you have companies like Microsoft and Google and those natures, the Warren Buffett of the world, these are big players in the market, and their role is they're very conservative by nature, and what they want to do is they want to buy value and sell overvalue. The difference in the funds, the difference in the funds is that in funds we have it in which they tend to be momentum traders. So when a market makes a new low or makes a new high, the fund and the specs jump in thinking they're going to catch trends. And one of the reasons why these funds and these people lose money is because markets are in trading ranges around 80% of the time. So 80% of the time, markets have, let's say for a better term, a term that you may know, like false breakouts to the markets. These false breakouts attract people to get long at the high and to get short at the low. So they're buying maybe something that's overvalued to become more overvalued, or more of a rally to go to higher levels, or selling it to go down to lower levels. So that is the role that they have. Okay, that is the role of what they do. So there are different roles. There are times in which they go the same direction when the CM is long and the funds are long. So if the funds are selling, if the commodity operator is selling to the funds who are buying, at some point the CM, the composite operator, composite man, needs to buy those shares back to put them back in equilibrium. So he conducts these sharp breaks in the market or rallies in the market, depending on where it's at, to liquidate and to get his money back. So here's an hourly E to the S&P, okay? And to give you an illustration, because sometimes it's easier to give an illustration versus to talk through it, okay? So we see the market has a reactionary high. As you know, we want to mark reactionary highs, and we draw that line across. That line goes across forever and ever, right? That line will always be there until it changes character. We take this low here and we see a market makes a particular low. Since it reacts from here and holds this low here, we want to mark that as our trading range. Okay. So obviously, the selling away from here, like putting your hand on a fire, and the CM or the large interest sold into that area because they thought that the market was overbought. Okay. And many times you'll see the signs of that by large ranges near the end of a move. That's kind of capitulation or some type of climatic behavior where all the funds are rushing in buy, or selling, sell. The CM recognizes that volume, that price action there. He allows himself to sell into it. In this case, we get that break from the overbought condition. And remember, we could tell that by a point and figure chart, or we could tell that by our reverse trend lines. And the market has a break. You do not want to sell that first break and reaction because the market's coming from strength. The CM is replenishing what the CM sold to the funds of back here. He's buying back what he sold at a better price. So that's that back and fill we talk about. This is the left-hand side of the trading range. This is the left-hand side of the trading range. It's when your level of knowledge becomes very, very poor because of volatility. Because you don't know where the market's going to stop. You don't know how far it's going to retest. You know very, very little about that markets. We get some type of rally. And again, the market falls short of resistance. So just like you'd want to buy the first retest, you'd want to sell the first retest up here. Well, this bar never gave you a plans to buy. This one never gave you plans to sell, which is okay. Mark goes back down here. The middle of the, so this left-hand side, the middle of the trade range, and people call that stage 3, basically, which doesn't really exist in the wyckoff world, but people added that. That it's very smaller range and less volume. Smaller range, less volume. This is the overnight volume in Europe, so it doesn't really, give you that type of thing, but it's smaller volume. As you progress through it, and the composite operator makes a campaign, he will begin to show strength of markets. He'll begin to let the market get to the right-hand side, which we don't know what it is, but we allows the market to come to a situation where we have absorption. Yeah, we have those high-end closes on the right-hand side, increasing volume, and then eventual springboard for markup. We did a series of videos on that one in one of the courses. Okay, it's a very important aspect to the market. If we don't get that aspect of the market, if we don't get that situation, the market's probably not ready to break out. Market goes higher. We see that increase in volume. This is the opening range of the stock market. Volume tends to be higher in the opening and on the closing. But remember, this is the first retest of the reactionary high right here. This will give you a situation in which it will have temporary stopping action because the market needs to consolidate again before it goes higher if the action is bullish. So in this case, we do not want to buy this. If we get about 4 or 5 closes above here, the CM is not selling into it. If the CM was selling into it, you would see a market that does this. And that'd be called that long liquidation by the funds. The CM would sell into it. If you don't see the market move away from resistance area, the composite operator is not actively selling. He expects market to go higher. That's why we want to buy the springboard on the right-hand side. If you get that selling, and the market's not ready for markup, it knocks out the funds, and the CM gets to buy at a better price. In wyckoff, we don't have things called breakouts per se. We watch the market's behavior with strength and weakness. If a market on the right-hand side does get above resistance and does show vertical absorption, then we want to buy that because the market looks like it's going higher. But we don't have like 1 or 2 bars that say breakout like a lot of systems, like above the 20-day moving average. That doesn't necessarily exist per se. So you can see the market basically holding near the high, but the reason what happens is that you see those closes that are low end, high end, low end, high end, low end, high end, low end. Those type of closes we talked about earlier are more of temporary stopping action versus continuation action upside. Thus, you got the upthrust position in this market here as the current chart. So, the way to look at markets with the CM is the CM will buy value, the CM will sell overvalued, or markets that are ahead of itself. In other words, buying Coca-Cola stock in August for December is, buy Coca-Cola stock in January, anticipation of July being hot, may be premature, and the market may not be ready to go mark up. But in April, when the forecast for summer is going to be a hot summer, that's when the CM will allow the market to mark up because it has the quote-unquote news behind them. In January, it's very difficult, or after January, okay, to mark up a Coca-Cola stock because the holidays are over and people don't drink Coca-Cola in the wintertime per se. That stock begins to go a little bit lower before the summer possibility of heat. So the composite operator is to be the facilitator of or actually the accepting of the selling and the buying by the funds and specs and making a market for them. This is why we don't want to see unnecessarily large companies getting hurt all the time, because if they get hurt, they take away liquidity. Liquidity in earnings and stock is what makes stocks go up. So in other words, earnings, because stock go up in earnings, but liquidity, the ability to borrow money is very important to the stock market. Those are two factors in the stock market that go up. Okay. So with less liquidity, like bond price interest going up, stocks need really good earnings to continue to mark up. Okay. That's what I explained to you guys in the newsletter. In this particular chart, we're not going to buy the first upthrust in the market. And the larger one, we're not going to buy this one either because of the behavior. Had these closes been high end before markup, that would be absorption to go higher. The fact that the market was lower, higher, lower, higher, higher, the market is not ready to mark up. The CM who buys support and sells resistance, this is resistance to the CM, unloading the shares that the funds bought, they sold to them, unloading position. So the CM basically is a opposite side person of the funds and specs who provides liquidity for that action. Now, the CM can't continue to sell something that's going much higher, so he conducts a break, selling into the market to recover some of all the contracts that he sold to the funds, and the game begins again. So we get to the right hand side, start to see high end closes near the creek resistance, or low end close in the ice support area, and that's going to give us either markup or markdown to the market. So, extremely aspect of the roll, they can't be on the same side. They're generally not on the same side. The CM provides liquidity, and he provides liquidity like in the middle of the range when the news is going on, liquidity. And then when he feels the market's going to break up the upside, he does not sell into it. He doesn't think the market's going to go mark down. He doesn't, buy into it. He allows the market, like in other words, you're not going to be in a situation where in the middle of summer the CM is going to be actively selling grains in case the market is a very hot summer. Okay, so he may allow the market to mark up and not sell into it because it's not at a price level that he thinks is expensive enough for him to sell into it. So he plays the liquidity factor, and he allows the market to rally, to break or rally when he's accumulating his line of position to the markets. So his role is to take on the contracts that the funds and specs sell him, also speculate to where he thinks the market is going to go. The one thing about the CM is that they have very large interest in lobbyists and people that are politics. So they get a list of policies by the government unknown to the public, believe it or not, and they act upon that. They hire the best weathermen in the world to get them the weather. So they hire with their money the most important people to tell them information. We don't need that. All we got to do is fire their coattails. Sure, we'll never be a leader of the CM, but we can imitate what they do and profit with just the same. So the CM role is to provide liquidity for the market. And when he thinks the market's marking up, he does not sell into it. If he thinks the market is not selling down, he won't buy into it. And he allows the market to play its paces and the market to go sideways. Hope you enjoyed the little CM talk. We'll discuss more as we go further on.